How's it going? I'm Andrew with Investors Hub, and today we're talking with Paul Schatz from Heritage Capital LLC. He's their president and CEO, and we're going to be talking to him about a couple of different things that are happening in the markets right now. We were just at an all-time high in the SPY, and then on Monday, right around noon, it just went straight down back to the bottom of the channel that we were in for the past couple of weeks. And right now it's somewhere around the middle, 415-ish area. And we're also going to discuss sort of the old idea of sell in May and go away. And lastly, he's going to give us some ideas on what he thinks will happen whenever we get those inflation numbers on Wednesday morning. And there's actually one more thing. He's also going to talk to us about some stocks that he's paying attention to. So with all the intro done, let's hear from Mr. Schatz. Please note that our videos are not designed to be direct investing advice. We're here to gather the perspective of different investors. Our channel and our content should just be one stop on the journey of trying to find out where to put your money. So when I reached out to you for this interview, the SPY was trading at all-time highs, and that was going to be the sort of background of my question. But since about noon yesterday, we've seen nothing but red candles on the SPY. So what do you think is going on in the market to cause something like that to happen?
So good to be with you again, Andrew. Thank you for having me. I think the SPY, this is nothing more than your typical routine, normal, healthy bull market pullback. I'm not even going to say it's a correction because I don't think right now it has the legs to go even 10%. Maybe it's a mid-single digit pullback in an ongoing bull market. It's one that I think people can buy and should buy, but be prudent about it. It's not, well, maybe it will be the rising tide lifts all boats again. I sense that it won't be, but I also don't think it's the time to throw caution to the wind and to buy one or two names in your entire portfolio. It still is about the best offense is a good defense. As you have your stocks run into these uncharted territories and blue skies, there's nothing wrong with feeding the ducks. I love to, when Wall Street quacks and the ducks quack, you feed them. So when your stocks, your ETFs, some of your funds run into crazy territory, there's nothing wrong with feeding them. And then when nobody wants to own them again, that's when you start buying yourself.
So do you believe in the adage of sell in May and go away? And if you do, what about May makes that adage true?
Sell in May and go away was a well-researched, let's call it phenomenon for many decades. Yale Hirsch of the Stock Traders Almanac fame will say invented this or founded this or saw the research. So for a long time, like many things, in hindsight, it worked great. As things get discovered, the market's able to adapt and adjust and arb away any kind of seasonal edge. So first, do I believe in sell in May and go away? In a vacuum, I don't. If you look at, so you have to break history up. Let's just talk about modern history, really modern history, which is post-2000. Since 2000, if my memory is right, there have been 21 Mays and 14 of them were up. So just the month of May itself. The month of May used to be historically a lot weaker than it's been. Now, sell in May and go away was you sell stocks on April 30th and you buy them back on Halloween or thereabouts. Since 2000, I think 16 out of 21 sell in May and go aways have been up. That's pretty hard. And if you go back in 2001 and 2002, the market was hit very hard April through October in the sell in May and go away period, because we were in the midst of a almost 3-year bear market. It's very hard when something goes up 16 out of the last 21 times to believe that phenomenon still works. So I would say historically it looks beautiful, and the longer the time horizon, the more people will believe in it. But the more recent, if you look at the last 10 and 21 years, clearly it has not worked at all. And frankly, you've been better suited to buy in May and go away.
So when we last spoke a couple of weeks ago, it was in the context of the infrastructure announcement. The bill hadn't been announced, but Biden was coming out and he was giving his speeches on and giving us some soft numbers officially. And you said that you were watching companies like Vulcan Materials and Caterpillar. So has the window of opportunity to buy those closed, or do you think that there's still upside?
So a couple of things, Andrew. First, what I said, I didn't think the infrastructure plan as being floated, where it was going to be one gigantic bill, had any shot. That, to me, that was DOA. I wasn't going to waste any of my own time on it. I thought they would break it out into two plans. One would be traditional infrastructure, bridges, highways, tunnels, and roads. And the second would be new age infrastructure, where we're lumping things that perhaps are not traditional infrastructure, like childcare, things of that nature, the greening of America. I thought the traditional infrastructure bill would get bipartisan support. I still feel that way. I think the secondary bill is DOA. I'm not going to spend any more time on it. To answer your question more directly, yes, I think so. Those stocks, Caterpillar, Deere, Martin Marietta, Vulcan, PAVE, the ETF, PAVE, they've all gone up at a pretty substantial pace since we last spoke. Would I buy them at new highs? Frankly, no. We own Caterpillar. We own Vulcan, which is one of our bigger holdings. We recently bought the Mexican cement company, symbol CX, Charlie X-ray. So I'm going to add to CX at some point into some weakness. And I would say the same thing about Caterpillar and Deere and Martin Marietta and Vulcan. They've had nice runs. We are seeing a pullback now. I do the same thing. If you believe in the infrastructure bill and the plan over the next few years, I'd continue to buy those in a weakness. And listen, when they go vertical again and the ducks quack, I would feed the ducks. I would not just sit there blindly with my eyes closed, watching them melt up the side of the page. So like anything else, let's have a plan. Let's have a plan in a weakness. Let's have a plan in the strength. But that theme should resonate at least for the next 2 to 4 years.
So what stocks are you watching in the market right now?
Well, I'll tell you what I'm not watching yet. We've severely underweighted to almost eliminated big tech into all their previous spikes this year. We've done a pretty good job of selling Netflix and selling Google and Microsoft and really reducing Apple to a very small position. I'm not yet ready to engage in technology yet. I'm going to, just not right now. But I'm still on the story that I started on January 1. We are overweighted with energy and oil services and banks and financials and industrials and materials. So I mentioned CX, the Mexican cement company. That's a new holding. We still like, obviously, Vulcan. We still own, JP Morgan. We added PRGO recently, which that's a new holding. I don't think I've ever owned it before. PRGO is a generics business, symbol PRGO. They announced earnings, and earnings were a little light. Every analyst hates PRGO. I'm looking for stocks that have not gone straight up again, which is hard in this environment, but PRGO is certainly one of them. It's got probably 8.5% free cash flow. That's strong. I think if you've got patience in that, it's a double. DaVita, which is our single biggest holding along with Berkshire Hathaway, that has also done super well, and a stock I would absolutely continue to own and buy into weakness. But I would not go the high flyers. Don't have interest. They're on my screen. I'm looking at them, but not right now. And I'll say this, I've been a vocal and bold bear on Coinbase since it IPO'd, and as well as Snowflake and Palantir. I've laughed at people who chased them in the first day and week after that. But I like the long-term story of Coinbase. I just think it was idiotic where it priced, and my gosh, people paid over 400. So Coinbase and Snowflake, as they shake out and they begin to lose their volatile nature and go sideways, those are two names that are on my radar screen right now. I'm going to be super patient with, but just because they collapsed from their IPO, perhaps they're another Facebook, went from, I think, 42 to 17 after its IPO.
So I've got a special bonus question if you have time.
Absolutely.
So tomorrow morning, I think at 8 a.m., we're going to get inflation reports. So how do you think that is going to affect the market, right? If we have higher than expected inflation or lower than expected?
So I just did a video on my blog on Sunday, specifically on inflation. When I talked about in our forecast for the year, I started getting on the inflation kick last summer, July, August. And I said at that time, the inflation genie's out of the bottle. She is not going back in 2021 or 2022. Inflation is a long-term story. I said that, whatever that is, 8-9 months ago. I firmly believe it today. I said it again on Sunday. Inflation is out of the bottle. This is not like earlier this century. It's not like the 1990s. We're going to go back to shortages. We've seen the chip shortages. So that's not a commodity, but we've seen chip shortages leading to inflation. We've seen corn and wheat and soybeans and energy prices. Those are all inflationary. A lot of companies said, Andrew, we see inflation and we are going to begin to pass those costs along to consumers. So tomorrow morning, how will the market react to a hot inflation number? I don't think terribly poorly. I think people are starting to accept it and be a little worried about it. But unlike Yellen and the Fed, I am firmly opposite. I believe it's not transitory. I think it's systemic. I think inflation is here to stay for a long time. And how that impacts your viewers and the average person, so many people have owned PIMCO Total Return Bond Fund and Vanguard Bond Index and Fidelity, Loomis Sales, those huge bond funds. Those are the ones that people have, they've been like ATM machines for 40 years. I think that's where people will be really shocked and disappointed how bonds are going to behave if we get this long runway of inflation. What was an easier play for them is going to be a pretty significant headwind for years to come. So people are going to have to change their arsenal, their toolkit of how to attack it. It's not, and buying inflation protected bonds is going to be a short-sighted and probably a foolish way to play coming inflation for years to come. There are much better and other ways to do this.
Any final thoughts?
Look, this is the first year of a new presidency. We just ended the first year of a new bull market. Second year of new bull markets usually see a 10 to 13% decline. I said in my forecast on January 1, between May 1 and September 1, which is I know it's a big window that I would hone in. I think the market was going to put in some kind of peak that would lead to a double-digit decline. I don't sense that the peak we just saw was the peak for the double-digit decline, but I still think it's coming. May through August, we're going to put in a peak. We're going to have what normally is seen in the first year of a new bull market, and you've got a new president and a new party that normally leads to some kind of decline. But I don't think the bull market is ending May through August. And I want people to have a plan. Don't go out there blindly and hope and pray that your stuff goes up. Have a plan for good, have a plan for bad. But I think this bull market certainly has legs and a ways to go.
Thanks for watching. And if you like the video, be sure to like, comment, and subscribe. And all the YouTube stuff. Share the video with someone that you might know. And also, you should check out our video where we talked to Vince Martin from Seeking Alpha. We're talking about pretty similar stuff to what we talked about with Paul Schatz today. And I will put a little card up above me that you can click on. But the cards, they kind of stink. I miss it whenever you could put little boxes on the screen for people to click on. But if you don't click on the card, then just look for the video that looks like that. So, yeah, I'll see you again soon.